is officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. Today, we are talking about the debt ceiling crisis and how it's going to affect your wallet. With me, as always, the man I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody.
And with us, as always, also lending a helping hand in the chat, making sure that you get what you need, our amazing community manager. We call her MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And if you are joining us today on YouTube, on the podcast, anywhere else you may be doing that's not live in this audience right now, and you haven't yet signed up for our awesome investor class, the smart way to invest in rental properties, the Not Your Average Investor's Guide, then you can get it for free until, I keep messing this data, but I think it's June 21.
June 19th.
I told you. Until June 19th, it is in beta. You can get the brainchild of genius concepts over here and funny guy over here, learn everything that you need to catch up to the phenomenal real estate knowledge that is inside of this room that joins us every Tuesday and Thursdays. So you can just focus on the inside jokes. You get to that class by nyaiclass.com, and up until June 19th, you can get it 100% for free by putting in the promo code before you check out, NYAI guide free. They made it as easy as possible for me to read to you. And you get it for $0, GC.
I love it. Think about this as the quick start class to getting up to speed with being a Not Your Average Investor in this community. Or if you are investing in rental properties and you're listening on the podcast, you haven't joined here, you should probably be here. But either way, it's a quick start class. It's everything you need to know to go from 0 to 60 miles an hour to get in the fast lane and actually start to build your rental property portfolio.
That's right. That is what we're trying to do, is enable you to make the best decisions possible, whether it is with JWB or you're investing in another market for whatever reason, just the right questions to ask, the right way to think about it so that you set yourself up for success when it comes to passive real estate investing. And I think if you pay attention in there, it's going to tell you that to join us live for one of these shows at some point, because then you get to be part of what you see.
The roll call.
The roll call, baby. We got the real estate maven from the mountains of Colorado in the house.
That is Ms. Leslie Wilson, of course.
Wilson. We got our trademarked West Coast friend with a good morning, good afternoon,
Mr. Nadeem Shah. I don't normally get to announce Nadeem. You usually take that one.
I know,
so
man.
I'm ready to rock.
I'm putting a lot of faith in you. We got Big Papa in the house. We love it when he calls in Big Papa.
Pops, hello. How are you? Good to see you, buddy.
Jay Cohen, one father of Gregg Cohen. Throw your hands in the air if you're a true player. We got the fairy godmother of the Not Your Average Investor Show community checking in from lovely Monterey, California.
Ms. Jen Filson.
We got the ringmaster of the Not Your Average Investor Show community,
Andrew Barnhill.
We got our regulars, the second family of the Not Your Average Investor Show community, Gary and Rosalind Riley from Marietta, California.
We salute you.
I think we should change that
to
our regards. So we use more R's for the Rileys, the regulars, Marietta.
I'm a big fan of alliteration.
Our regards.
Right on.
We send our regards. The Rileys. Just more.
Are we still doing this?
Yes,
right.
We regard you. PBT.
You.
We got Leo Barraganan.
Barraganan.
From the Bay Area, California. Let's rock. We got Ian Rumpf in the house with a good morning. Is that a new name?
New name.
Yeah,
welcome to the party.
Good to have you here. We got the early bird in the house from Columbus,
Mr.
Ohio.
Dean Curry.
Mr. Dean Curry in the house. We got our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Stepping in and checking in with us. Good to have you, Aaron. Who else we got in here? We got, all right, Chris Gonzaga.
From the illustrious Hudson Valley.
The illustrious Hudson Valley of New York. Good to have you in the house. We got Sergio Pareto in the house.
Go Gators.
We got the first family in the house.
Oh,
the patriarch and the matriarch, Ken and Carolyn Moline.
We salute you. Have you noticed how there's an aura of reverence when we talk about the Molines? We slow down our talk, so we have the first family here.
We got somebody checking in with us. Buenas tardes, amigos.
Mr. Bill Shields.
Mr. Bill Shields. We know who that is. Good to have you, Billy Shields, and Eddie Harris from Hot Atlanta.
Hot Atlanta, baby.
Checking in. Motown of the South. All right, let's get right to it, GC. This debt ceiling thing. I am not a smart man, but I know how to read the Wall Street Journal. and what I gather is we have a budget and the budget comes due in most presidential terms. When we have a split house with, executive and the legislative branch, we tend to get into these showdowns, right? We tend to get into these like, who approves the budget? And that's what's happening right now. There was a bunch of discussions about how do we increase, decrease, what do we spend on? And it tends to lead to a lot of political theater, from what I understand. And in order to negotiate and in order to exert your will when one side is against another, people like to posture and hold you down to the thing. And when you're negotiating for something, you got to be the one that's willing to walk away. So they bring it right to the end. And as a result, we get a whole bunch of news feed blings and blips and whatnot about like a debt ceiling about to hit. And if we don't close that deal, if we don't figure out a budget and approve it, then the US gets their credit downgraded, right? That's kind of like the mechanic that was at plays here. And then we'll talk about what ended up happening, right?
Yeah, I mean, the ramifications of this are even way more drastic than just getting your credit rating downgraded. I mean, you do as many Google searches as you want, as many ChatGPT prompts as you want, talk to as many professionals as you want. Nobody really knows what would happen if the US defaulted on their debt.
Yeah.
Right. Like the world economies there would be a lot there. So, but the thing about the debt ceiling crisis here is this isn't necessarily like, hey, are we going to approve more money to spend here on this or that or whatnot? This is like the most easily telegraphed problem that everybody in Congress has known about for a while now, because it's not approving the new things to spend money on. Those things were already approved. It's just that the debt ceiling, the cost to be able to fund that stuff was going to get too high in terms of what the ceiling was. So it was going to go over a predetermined ceiling. But it's not like it was approving new stuff or all of this other stuff. It was like, listen, we already approved all this stuff. We already know what our revenue base is. We know what our expenses are. We knew the cost of the debt that we incur. Everybody knew that at this point in time, there was going to be a debt ceiling problem. And, Congress did what they do best is they, created a whole lot of brinksmanship because, whichever side of the aisle you're on, everybody tries to use whatever advantage they can to get one part or another. And, ultimately it created a whole lot of noise in the system because the ramifications of defaulting are just terrible for the world.
Yeah, that makes a lot of sense. When I think of noise in the system and this type of stuff happening and people playing with like really, really, really high stakes, I think to myself, I want to stay out of that party.
Yeah.
Right? Like,
yeah,
I think to myself, as an investor, I don't want to be white knuckling what's going to happen here as much as possible when this type of stuff is happening. It reminds me of something that we talk about often, this idea that the price of like volatility in the markets have changed based on the distribution of information, right? Like before we talk about the debt ceiling thing itself, I think I would fail our community to not point out the fact that we are more than ever driven in this like new cycle of things that could happen that could then hit a liquid asset that would then go up or down in an instant, right? Whether it's, we like to attribute this thing to Bitcoin, but like the stock market very much now is at play these days. The more polarized we become and the more that the pendulum is likely to swing between good news and bad news, it feels, I don't have any data to prove it, but it feels like that is starting to correlate more with consumer sentiment now gets more polarized, and the more polarized that we get on consumer sentiment and the more connected that transactions become electronically and seamless, the more things can take big swings, right? So the stock market, individual stocks, whatever fund sector that you're investing in seems more vulnerable than ever to the news cycle.
I think there's a feel component that you're talking about, which I feel as well. And then there's just the reality that paper assets that are extremely liquid will be way more volatile. On the other side, so paper assets that are way more liquid, think stocks, right? Bonds, right? On the other side, there are hard assets that are not nearly as liquid, and those will be more consistent. Think about rental properties, right? So in this world, and that's a good theory, and there's no data to prove the effect of the distribution of information on this, but like anything that you're watching right now, you're seeing, listen, look at the things that we have dealt with as a country just in the last, year or two, right? I guess we'll start with the pandemic, right? Nobody saw that coming, right? That dropped the market like 30%, the stock market like 30%, right? Real estate did very well. It was consistent and then it went way up afterwards, right? It didn't have that dip, right? We just had a bank run or a potential bank run. We had the second largest bank collapse in the history of the country. People were concerned about that. Right.
Yeah. And tying that into like the distribution of information and like the freedom of like moving things, right? Like a pandemic that came from one part of the world. And now because the world is so interconnected, people travel much more. There's like a freer movement of people than ever before because commercial airlines and blah, blah, blah. And things like that spreads. Bank run because now you can put something in Twitter by one very influential person and now 100 influential people also tweet it. Bank run.
That had a big impact.
Yeah. So
on SVB for sure. I mean, and you think about the geopolitical connectedness and how this affects the stock market and these paper assets that are liquid, right? We have this terrible war in Ukraine. We have inflation, which has been raging for forever now, and that is the reason why the S&P 500 is down 15% since its previous high going back to last year. Now we have the brinksmanship that brought the United States government to the edge of potentially having to default on its debts and on its payments of other important actions and items for Americans and for those abroad. And, all of these things affect these paper assets that are more liquid, much more than a hard asset that is slightly illiquid. So the idea, and people have been talking about this for a long time, I don't want to get into real estate because it's illiquid. It's illiquid. I think a lot of people are happy about the fact that you can't just like hear a tweet or read a tweet and hear something and then all of a sudden sell your real estate, because that creates consistency. And that's one reason why rents are so sticky, right? Even though affordability is a challenge, rents are still high. Right? They are not dropping, right? Rents have never gone down year over year across the US, right? It's one reason why home prices are still high. They are not dropping, right? So this illiquidity that people talk about in real estate is your friend in many, many regards. Yeah,
cool. So I wanted to touch on that just in the door, right? So then now, when it comes to the debt ceiling proper, you see a little while ago, I was like, yeah, because if the debt is too high, then interest rates are higher. And you're like, that's not necessarily true. How do you think about the national debt and the way that it, I don't know, man. How do you think of it as a, you're not a macroeconomist, but like when you're thinking about concerns over the national debt, do you have any?
Yeah, it's like if I put my business owner hat on, or even my if I think about my finances personally, I'm like, we're in some trouble, right? We don't bring in enough income as a country to handle the expenses that we have as a country. Mm-hmm. And that's never a good thing. And at some point, if the United States government was a business or a family, they would have some serious issues, financial issues. At the same time, the government can print as much money as they want, and we're still the reserve currency for the world. So what are the ramifications of us continuing to raise our debts, higher and higher and higher? I don't think anybody really understands, what the negative ramifications are long-term of that, because we've just been doing it, at least in our recent history, and we're still the world's reserve currency. So it's like, to me, I know that we are going to have a high national debt. I think the government is run different than a business because it can print its own money, so it doesn't keep me up late at night. I would like for us to be run more like an entity that has more revenue coming in than expenses, but I feel like that is a pipe dream at this point. And so anyways, how does it make me feel as an investor? It doesn't really affect my decisions knowing that we have a high national debt. It is what it is. Yeah. I'm not going to stay up late nights worrying about it. I'm going to make decisions in my own sphere that can set me up to earn the best risk-adjusted returns, knowing that we are largely spending more than we bring in as a country.
That's fair. What I hear in what you just said is another unprecedented situation that we find ourselves in, right? Like, I feel like we just keep stacking unprecedented situations, right? We've never had the internet before at this scale. We've never had, the ability to move anywhere and still work,
Yeah.
right?
There's a lot
Like,
of new
not
stuff.
have to live in New York to work in Wall Street kind of thing. We've never had such a long run of increasing national debt. And I feel like our world operates on certain assumptions that continue to be changed and changed and changed. And when I think of the idea of this is an unprecedented continuing to increase our national debt because we're still the world's currency, what you're not saying is that we're the world's currency until we're not.
Yeah. And then that would be a big deal.
And then that becomes a big deal, right?
Yeah.
Like, the other side of this coin is either at some point we default on our national debt and our credit rating gets dropped, or at some point the rest of the world, which is making moves towards it, decides, you know what, United States, you don't get to be the world's reserve currency anymore. And both of those things represent black swan events that we don't know what would happen.
Well, yeah, it's like, we can print as much money as we want, and we're the world reserve currency right now because the world looks at our currency as being the strongest to hold, right? But if, this idea of us defaulting on our own debt would be self-imposed, because we would just have a debt ceiling that we would not raise, almost like we did here.
Yeah.
So I don't think that's likely, right? I mean, what's more likely is we continue to fund our activities through debt and devalue our own currency by doing it that way, to the point where the world doesn't look at our currency as the strongest currency to hold, as the reserve currency. And then we have a big problem. Then this whole idea of us just solving our own problems by printing more money has real ramifications, and it's not as easy to do that. Yeah. And so nobody knows if and when that may happen, but if we get there, that's a big problem for all of us.
Yeah. I can see that as a big problem for all of us. And I feel like the only thing it's kind of what we talk about, the way that you protect yourself from that issue is holding hard assets. And before I even get there, it's the big problem becomes, if we're no longer the world's reserve currency and we can't just bail ourselves out by printing our own money, it means that we would be at risk of like runaway inflation type of stuff that has happened in other places. Is that the big risk? If all of a sudden we just can't print and have it still be worth whatever it was worth, it wouldn't be pegged to that?
Yeah. So if, overall, if there was less demand for our dollars, it would cost more for us to fund our operations. We would have to offer higher yields for other currencies, or for other countries to want to buy our treasuries and things like that. So if the world no longer valued our currency so much because we deflated it, because we printed so much money, in essence, it would cost a lot more money for us to do the same activities as a business. Yeah. Or as a country. I mean, and when I say a lot, like, I can't even tell you how much more it would. It'd be trillions more just by a loss of perceived value of our currency. So like, I put all of those things in this bucket of like, let's not get there. And I don't think that we're there right now, and I don't want to create some doomsday scenario. But like, all of those things of like, we're no longer the world's currency, a default on our own, on our debts, right? The debt ceiling crisis coming back in the future, and us not, coming to an agreement. Those are all things that like could happen, but the effects are so negative that I don't spend a whole lot of my time thinking about that, because there's a whole lot of things that I can do right now to make better decisions with my money, or that you can do with your money. Now that we know that the debt ceiling crisis is averted, don't have to read any more articles on it. Yeah. Now, what impacts is yet another volatility, a disturbance going to have on the S&P 500? What impact is that going to have on bonds? What impact is that going to have on rental properties, right? Because, when you throw these disturbances in the mix, I think of these disturbances like this. I think of the potential bank run that people were scared about, the closing of SVB, Signature Valley Bank. Oh, goodness, right? You just go back to the war in Ukraine. You go back to the supply chain challenges that we've had. All of these are disturbance. The fact that we've raised interest rates by 5% in the span of a year, which is the highest that it's raised, in a year since the early 80s.
Yeah.
So all of these, like, what more can these paper liquid assets like the stock market, what more can they bear before one of these things is the match that lights it and then goes towards recession and goes towards negative performance in the S&P 500? That's the question that I'm wondering in my mind.
Yeah. Yeah, that makes sense, man. Where my head went as you started kind of like talking about that stuff, I was like, well, what would happen, if things get more expensive for us to perform our activities on the world stage? I think small, right? I think of places that are built for people that are not from there anymore, right? Like and I'm going to bring this back, as I always do, to being from Miami, and the idea that like Miami is too expensive for locals because it's always being sold to other people. I've heard that same thing in Costa Rica. When I go surfing in Costa Rica, they're like, man, things are too expensive because it's from other people, because stuff here is cheaper, right? For them.
Right.
And I think of what comes with that is this like increased cost of living, because everything that you do is cheaper for people not from there to do in your own home. And I also think of increased real estate prices.
Yeah.
Right? Like that is essentially what the Costa Ricans are complaining about. Like, man, I can't get a home. They say the same thing in Miami. It's like, man, I can't go out to eat, and I also can't afford to buy a home anymore because real estate has gone up, because all these people from outside see this as like, oh, this is a good deal now. I'm gonna come play in this sandbox where it's much cheaper for me. So that's the other thing, right? Because I also think of like investing in hard assets as like, all right, gold is another cool hard asset that you can invest in, but it doesn't have that same level of upside of if it's cheaper for people not from there, right? Like gold is kind of standard around the world, and it has a global demand, where like a localized real estate demand on something like that does have a general upside as well, if we were playing for that hedge.
Yeah. I mean, I agree with you.
Okay, cool. So that is all the things that we're talking about. Not your average guest. So somebody came in from the text. I don't know who it is. I'd love to know who typed in this comment, but Creature from Jekyll Island is a must read or listen to right now. JW is a great place in its leadership, unlike some banks, right? So I've heard do you know what that book is about, Creature from Jekyll Island?
No,
I can tell you I go to Jekyll Island every once in a while because it's about an hour away, but I've heard about that as like some kind of, it's like an Ayn Rand kind of like macroeconomic book.
Really?
Cool. Check it out. Yeah. I don't know who wrote it or whatever, but let us know in the chat. But I've heard of that. It's like a big economic concept book of like a scenario of something happening. All right. So that's just kind of like big picture stuff when it comes to the debt ceiling. And we're having this conversation because I think you get a lot of these headlines and you get them talking about it, but nobody's really just like going back and forth of like, what does it actually mean for the average person? They're just talking about who's doing what on what side of the aisle, right?
Yeah.
So then let's talk about what actually did happen. They got to the brink of it.
Right.
They signed a debt deal.
Right.
So now economy continues to run. We don't default on our payments. Our credit has not been downgraded or anything like that. Stock market itself didn't seem to react too much. It's been okay. Like they didn't push it too far.
Right.
My main takeaway when I started reading these articles is in the Wall Street Journal, it says, at the end of the day, discretionary spending will actually rise slightly next year after inflation, according to Goldman and Sachs. The Congressional Budget Office estimates that the deal will reduce deficits by 1.5 trillion over the decade, which sounds good, but it simply just means that the federal debt, which is now 97% of gross domestic product, will rise to around 115% in a decade instead of 119% in a decade, right? So we're still growing the debt. We're just growing the debt ever so slightly. And I don't really know what it means to have a debt of 97% of gross domestic product. That to me sounds like I am in debt barely less than what I make.
Yeah.
So
it's like if your interest payments on your debt that you have equaled all of your revenue for you as a family.
97% of that.
Almost all of it. Yes. 97%.
Yeah.
It's not healthy.
Yeah. So, and it's moving towards 115% of what you make.
Yeah.
What was your takeaway from like the things of what the outcome became? Like, did you read a stat like this? Is that kind of like your big takeaway that nothing has really changed? We're still on a similar trajectory?
Yeah. I feel like this was a whole lot of, brinksmanship for, relatively little gain on either side of the aisle, whichever side you're on, right? Like, I don't know, it's a whole lot of noise, right? And I just wish that we could come up with ways to solve this problem without relying on something like throwing the government into potential default in order to come to some type of resolution. I bet.
Yeah. So a resolution that didn't really move the needle.
No, it didn't really move the needle. It's the
Yeah.
same thing, right? We spend too much versus what we bring in. Now, whether or not you think that's a good thing or not, the simple fact is that our government activities are not supported by our tax revenue. That's okay to say.
Yeah.
It's not going to change anytime in the near future.
Yep.
And with the cost of the debt and with the trajectory we're on, it's going to be higher than our gross domestic product at some point here soon, which, I don't know if that scares me. It doesn't scare me. It should scare me as a business owner, as a person who's paying my bills. It should scare me that my interest costs that I'm paying are basically eaten up by whatever I earn. What about my housing costs? What about the food I buy, the gas, the insurance that I have, right? Like, it doesn't make any sense, but it's our government. And so they can print as much money as they want until they get to the point where we're no longer the nation's currency. So none of that really matters to me, honestly. Like, you knew that this wasn't going to result in this like huge sweeping change because they had like a week to put it together. They started focusing on it in like a week. So whatever they did, it was, I don't know. I don't think it was very meaningful.
I want to dig into the idea of why it doesn't matter to you. But first, I want to give a shout out to BJ McKay, who was the one that told us about the creature of Jekyll Island. He's from California. He says, "What's up, Greg?"
Hey, BJ, longtime client. Good to hear from you, buddy.
Yeah. And Creature from Jekyll Island is about the funding of the creation of the Fed, right? Which
interesting.
I think we should read it.
I love that.
Maybe we should do a little 9 Year Investor book club. All right.
Love it.
I would venture to say, Greg, that you're not worried about the debt ceiling crisis because you're not banking on your Social Security paycheck. Like to me, it's as somebody that hasn't amassed 300 rental properties already, and as you say, amassed an army of income producing properties that are going to take care of you when you're older, I still think about how much should my wife be putting in her 401k, and is that going to be enough to live? How much can I have 3 rental properties right now. How many more can I get to, during my peak earning years, so that starts maturing and starts producing cash flow in the back end, because I need to move away from the idea that the institution that most people have counted on in retirement, which is Social Security and or pensions and or the 401k system, does not give me the warm and fuzzies that when I get there, it's going to be enough.
Yeah. Yeah. I always wanted to build this retirement account for myself, independent of the other things that potentially were going to be there for me, like Social Security, and I hope it's there. But for me, one of my goals and one of the reasons I started to acquire rental properties so early on was because I had the opportunity to create wealth that wasn't dependent on somebody else doing something for me. And we all have that opportunity, and real estate's a great vehicle to do that. So yeah, I hope it's there. Listen, when our federal debt is 119% of GDP or 130%, there's a chance that we'll still figure out a way to pay for Social Security. Yeah. Who knows? I hope it's there.
Yep.
But for me, I just wanted to own that responsibility myself. And if I could do that, and that's why I started when I did, if I could own that responsibility and do something to set myself up in a very positive stance, then I could only underpromise and overdeliver to myself if Social Security was there for me later on. Yeah. And I think we all have that opportunity to do that.
I agree, man. And I think what we've been seeing in our community is this evolution from real estate investors that are looking to, they think like real estate investors, to people that are really just financial engineers that are looking at retirement down the line, and they just simply want a better portfolio because the system isn't necessarily working. And I think that this type of stuff that continues to happen, right? Like, is only going to push it that way, right? Like, I think we're always going to be, I guess I've never really considered myself a real estate investor. I consider myself an entrepreneur that needs to be wise with his money. But, in the 3 years that we've hosted this and made all these different relationships, it felt like early on, when I would bring up JWB and I would bring up the Not Your Average Investor Show, it was a lot of people trying to get educated on real estate because they wanted to be real estate investors. And as time goes on, it's becoming more people that are wanting to take control of their financial future a different way because the old way wasn't working. Are you feeling that, or is that just me as a novice?
No, I think you're right. I think people are desiring a better way to build a retirement account. They're desiring a better way to stack their assets. And you can label it whatever you want, stocks, bonds, real estate, crypto, whoever, whatever, but people are desiring a better way. And I think the message I've been evangelizing for 17 years now is that real estate's a better way, And so I think that's what our show has come more and more into. I know that's what our clients talk more and more about. That's what we get to talk about in our articles that we write.
Yeah.
I get to write for the Jacksonville Business Journal and the Jacksonville Daily Record, two of the publications here. And I just finished a couple of articles, and it's more along those topics. It's not, hey, listen, how to become a real estate investor.
Yeah.
I mean, think about this. You own money in your stocks and bonds and your 401k, right? You all own money in your 401k. You have money in stocks and bonds, but would you go to a party and say, hey, listen, I'm a stock person,
Yeah,
hey,
correct. Correct.
Now you can put your portfolio in real estate, your 401k, your IRAs, you can put that in real estate. You can put 25%, 50%, 75%, whatever, but you don't have to go to parties now and say, hey, I'm a real estate investor. You just are building a better retirement portfolio.
Yeah.
And it happens to be in real estate.
Yeah. For the record, I still think it's cool to go to parties and say I'm a real estate investor, but I think it's a trend that's going to get normalized to what you're saying, right? Like I think at some point, they made it easy to invest in stocks via the 401k. Before it used to just be like a group of people that were doing it,
Mm-hmm.
right? Like then it became easy to do it automatically at work.
Mm-hmm.
That didn't change people to say I'm a stock market investor.
Exactly.
Right. Then at another point, technology also allowed you to be a stock market investor independently without needing the gatekeeper.
Mm-hmm.
And I love talking about category design, and new categories create other categories. And at a certain point, the combination of technology and data and know-how will create a new opportunity in a market, which I think is where real estate is going right now. Like real estate is right at that tipping point where the combination of technology, the amount of data that's available to everybody to standardize something and widgetize something,
Mm-hmm.
and the few companies that have like been in front of this have now created a way to do just that. You're not yet at the point where you can stick it in your 401k
Mm-hmm.
through your company, but you are at the point that as an individual investor, without having to really think too much about it, you can say, oh yeah, I got a portfolio manager for my real estate portfolio, and I just have this much allocated into that without ever having to consider yourself a real estate investor.
Yeah.
And I think it's happening in large part due to people wanting to control their own financial future. That is going to be a growing trend that I think we see coming.
I think so. And I think it is so needed because I get to talk to friends, colleagues, clients, anybody I get to talk to. And if I ever had that conversation about where's your money, 80, 90, 100% of their retirement accounts and any other assets that they're planning for retirement, it's all stocks, bonds, mutual funds, right? That we have such an over dependence on an asset that is highly volatile, which is not a problem if you're young, but if that's all you know, eventually you're going to become old. You're going to get to a place where you're depending on that value being there at retirement. And then you don't know if a pandemic's going to happen, a war in Ukraine is going to happen, if inflation is going to rage, if a debt ceiling crisis is going to happen, you name it. You don't know if those things are going to happen. And what if that happens to you at 60 or 65? Wouldn't it be better to have 50% of your assets in the stock market and then 50% of your retirement account in real estate, which has proven to be consistent over and over and over again? Like, doesn't that just make sense? Like, I'm so motivated to talk to people about that because I know with, a lot of my friends and family invest with me. I know that as they get closer and closer to retirement age, I'm going to get phone calls that are going to be thank yous, right? It's going to be when I'm 55, my friend's 55 or 60 or 65. and something bad happens and a lot of their money's in rental properties managed by me, they're going to say, thank you, because I didn't have to have my quality of life go down when the stock market went down because I had all of my eggs in that basket. So yeah, man, I think what you said as far as this confluence of opportunity is happening right now. And there could not be a better time for people to be really thinking about how much money you have in one highly volatile asset.
100%, man. So a couple notes here from the community. Ken Moline says, for us as older retired individuals, our combined Social Security income amounts to about 25% of our total income. Our prudent investments in JWB real estate over the last 4 years now provides 75%, and JWB income does a better job of keeping up with inflation than the stock SSI.
Yeah.
Stock
Social Security. Social Security.
Oh,
income.
that's Social Security. And then Rhett Farber saying, I'm a passive real estate investor, lending money to someone like JWB who actively invests in real estate. Maybe not a sexy or high return considering appreciation over time, but solid 10% annual while sleeping at night as well. Love it. And then Chris Gonzaga says, when we were talking about being a real estate investor, he goes, it's a good road, but bumpy, which I think is another thing to talk about, right? Yeah. It's this idea. We were just talking about it this morning on the run.
Yeah.
That it's, if your 401k is doing its thing and you are, I don't know, 45, 50 years old, stock market takes a tumble, right? Like we go into a recession. Your spouse is not sitting there at the dinner table saying, man, I told you not to put money in the 401k.
Yeah.
They're not saying, what's up with Fidelity? Why isn't Fidelity? That's not what Fidelity promised us, right?
Right.
Yet, when we think about the real estate piece, if we are doing it, and let's say you have a turn, 1 year, and then a year and a half later, you have an eviction. Yeah. But all this time, your house is worth way more than it was worth before. And maybe you lost, I don't know, worst case scenario, 6 months of rental property income in having a vacancy that you had to go change because there was the turn and you had to put a little bit of money into the property. Your net worth still would be higher than that money in the 401k that just took a beating over a recession. Right. And yet you're sitting there cursing this real estate investment. Yeah. And that's the bumpy road. Yeah. Is thinking, man, this thing, I have a different relationship with this thing because I expect it to do all this other stuff that I've never put the expectations on my Fidelity 401k. I say Fidelity because I was the company that managed my 401k the last time I was working corporate. Right. And yet your net worth is still way higher and your path to retirement is still much closer than it was before, regardless of that vacancy or eviction or foreclosure or whatever it was. Yeah. It's like, define bumpy. What's bumpy mean? Yeah. Does bumpy mean that your actual value of your assets go way up or way down? Because that's the S&P, right? That's your typical 401k that's in stocks and bonds. Right? It goes way up, it goes way down, right? That might be somebody's definition of bumpy. But in real estate, we talk about how bumpy it is, but your swings, your volatility is like this. Yeah. Right? Even if you have a big turn and it costs a few $1,000s. Yeah. Right? The volatility of your net worth. Yeah. Right? Yeah. Because if my net worth is in the market and it takes a 15% haircut, my net worth just went down 50%. Yeah. If I have to evict a tenant and it costs me $20,000. Well, that's really high, but okay. Super high, right? Let's call it super high. Yeah. But my net worth of what that property is worth, what I can liquidate it for, and what I have options to like do with that net value. Yeah. Still there. Yeah. I mean, so like, we'll just run crazy numbers here. All right. Let's say that you had $20,000 of expenses that like hit your bank account for your rental property because of all these crazy things you're talking about, but it's a $200,000 asset and it appreciated 10% in that year, which is actually low compared to what it did last year. Yeah. Actually appreciated more. Yeah. But you'd be net neutral as far as your volatility of net worth in real estate. Yeah. It's just about the pain points. Yeah. In traditional assets and stocks and bonds, it is built in such a way to shelter you from the pain points, right? But ultimately the asset is way more volatile. Yeah. So like, what do they do to make sure that it shelters you? Well, it's through your company 401k plan. So you didn't even see the money
It didn't even come to your bank account and then you invested it. No, it was invested before you even made your net paycheck.
Yeah.
So you didn't even feel it. You feel like it's just money that's given to you.
Yeah.
Right. And then, it is an asset that does not have the ability, if something goes wrong on a monthly basis, it doesn't have the ability for a capital call from you. Right. You don't have to reach into your bank account to pay for whatever stocks, bonds related. It is what it is. But at the end of the day, so that's all really good stuff.
Yep.
But at the end of the day, the asset value goes up and down like this. I mean, we're down 15% from a previous high, which was last year in the S&P 500. It's down 15%. Mm-hmm. So at the end of the day, the most important thing is way volatile, but the experience of owning it is so easy and so simple. So it lulls people into thinking that it's a better asset.
Yeah.
On the real estate side, and this has been our mission for creating this company, is how do we deconstruct this to improve this? But the real estate side, the rental property side, does such a good job of pointing out and putting in your face all of the negative things on the experience side. Mm-hmm. But the asset that's underlying it is incredibly stable and consistent and grows more than the stock market. So it's, what happens on the real estate side that you're all probably worried about? It's if a tenant moves out, it's a big expense. I might have to dip into my pocket to pay for it. That's a capital call. Mm-hmm. Capital calls in general real estate, that's a thing you got to be worried about. Yep. JWB, we do a lot of things to mitigate that risk. So if you have a question about how we avoid that for our clients, you should be talking to us, because that's not the same risk that you face as a JWB client.
Yeah. And if you want to talk to JWB, go to chatwithjwb.com.
Yes, you should talk to us.
Helping you out here, bro.
Yes, thank you. And all of the benefits that come along. Well, and then there's all the teammates that you have to handle, to do typical real estate. Yeah. Your real estate agent, contractor, your property manager, financing, insurance, everything is a different person. So, and then, when something positive happens, you don't actually feel it in your bank account most of the time, because your biggest profit centers are home price appreciation, principal pay down, tax saving. So all of those hidden things create this incredibly powerful, consistent asset, but it's largely hidden from view on the rental property side. Yeah. Yeah. But that's why we have an opportunity to build a great business. If it was easy, everybody'd be doing it, everybody be investing in it. So.
Yeah. Chris Gonzaga from the illustrious Hudson Valley also says those bumps are also, by the way, tax shelters when it comes to real estate.
There you go.
Awesome. We had a question here from our boy, BJ McKay. What is in California? What is your thoughts on insurance companies not writing? You know what? I just want to say real briefly, we're bringing all this up. We just went on a long rant about how great real estate is. I feel like I have to recontextualize it for the subject.
We did.
Because we are talking about the increasing trend of the things that we thought we could count on, that we don't necessarily need to control, no longer being there for us in the future because of all these different black swan events and compounding situations that are leading to something, the future being different than the past, right? I think at the end of the day, all this stuff makes sense in the context of, if you believe that the future of the United States of America is different than the past of the United States of America, then you probably want to be more self-reliant in when it comes to your financial future and less counting on whatever default system is already there that's made to support you, right? I just want to reframe that to not think that we're just sitting there going, real estate, everybody do business with Gregg.
Yeah.
That's why we're talking about this. And by the way, if you do want to do business with Gregg, go to chatwithjwb.com. So now that being said.
Well, before we jump in, I wanted to make one more point when it comes to this debt ceiling crisis, as far as how it can affect your money right now, because as these disturbances come up, I think that's a point of inflection that you all need to be paying attention to where is your money. And I don't know which of these disturbances is going to lead to some negative performance in traditional assets. Mm-hmm. But I know as long as you keep stacking these things up with the pressures that are already on our economy, that it's highly likely that it's going to lead to future pain in the stock market. So use this as a point of inflection. I did a little bit of research here, and I just want to end the thought with this. The most recent example that we have of this debt ceiling crisis actually happened in 2011. Had the same type of brinksmanship that happened. I looked at the S&P, the effect of the S&P 500 in 2011, and I looked at it before the debt ceiling crisis and then after. Before the debt ceiling crisis, the S&P 500 was performing very similar to how the S&P 500 is performing today here in 2023. We were on pace for double-digit gains in just that year in 2011. The S&P is on pace for double-digit gains just in 2023 this year. Side note, that still is also 15% down from where it was from its previous high. So we had just fallen way farther than that. But to kind of do a market comparable here, we were largely in the same place. When you have a debt ceiling crisis and things get jumbled up across all potential economies or thinking about what ifs, the effects of that on the market are not known at this point in time. So nothing really has happened with the stock market, but who knows, right? In 2011, what happened is the market dropped for a period of months after the debt ceiling, and then it barely recovered for the entire year 2011. Now, we were not going into recession in 2011, right? We were coming out of recession in 2011. Many people think we are going into recession here in 2023 and into 2024. Let me remind you that the data shows that the S&P 500 drops on average 29% during recessions. That's all of the recessions going back from World War II. In that same data here, the best the S&P 500 has ever done since World War II in recessions is a 20% decline. So I don't know if or how much this debt ceiling disturbance is going to affect the S&P 500, but I am concerned about the value of it in the short run, just by knowing what happens in typical recessions and knowing that we are largely on a path towards a recession. So I want to leave everybody with this thought. Look at how much you're relying on the S&P 500. Look at how much you're relying on the stock market. If you have 80, 90, 100% of your wealth tied to that asset, maybe this is a time to reallocate into a hard asset, like working with JWB, or I want this to be even beyond JWB. Put it somewhere else. Don't be 100% reliant on it. That's the big message I want to leave you guys with.
It's great research, man.
Yeah.
That's you're really you've been really impressing me with like finding a nugget of a statistic or something to show up here and show, man. That's really cool. So, all right. Again, if that makes sense, then chatwithjwb.com is one option. Other option is just take your money out of the stock market, put it somewhere that you're going to preserve your capital, beat inflation, and create a little bit of cash flow out of it.
And you
right?
can do that with your 401ks, whether that's with your employer or outside of your employer. All of that money can be put into a better asset class.
Awesome. Awesome. Love that. All right, GC, I think that's a good button on that. Let's answer BJ's question. BJ asks, what is your thoughts of insurance companies not writing new policies in California? Florida had a few also. Do you see these actions slowing the home market down?
You know, I haven't had that question about insurance slowing down the home market. My simple answer, as Pablo likes me to be concise, is no, I don't see this slowing down the home market. There is too little supply, especially in the Jacksonville market, and too high of demand from population growth, that will be the number one driver of home values and rent prices. Insurance obviously is important, but there are ways, of course, to be able to get insurance, even as some of the insurance companies have not written the same number of policies, and some insurance companies have gone out of business, largely due to the number of lawsuits that the insurance companies were getting hit with. Short answer, no. And the insurance problem is largely corrected when it comes to the state legislation here in the state of Florida. Hopefully the same in California, where we think the worst of the problem is behind us and we think that it's getting better.
BJ, if you want a full breakdown on the insurance situation, episode 295 of the Not Your Average Investor Show, you can get it on the podcast, you can get it on YouTube, episode 295 with Whitney Ritchie. She gave a whole recap of what's been happening in insurance, what just happened in insurance, and what the future looks like. So highly, highly recommend that. Madison, I don't know, maybe you can share that in the chat, but want to help you out with that one.
And BJ, thanks for being here, buddy. It's been a little while. If you could just tell us in the notes, what got you to be here today? I'm always really curious when we haven't had somebody join us in a while. What sparked your interest? Would love to hear from you.
Yeah, good call. Make that two for me. I want to hear it also. The one shout out I want to give is I feel like Hervé Francois missed on the live show today because we're wearing matching colors.
You know what? So I don't know if you looked, but I was looking at your shirt now. You know, I'm colorblind, so I can't tell. But I'm thinking that's really, really close, right?
It's not exact. You have stripes. I just have like a gray, but it looks very, very similar.
We're so cute.
Matchy today. All right. Great show today, GC.
That's awesome.
Yeah, man. I think we were a little nervous about talking about the debt ceiling.
Yep.
Right? We're not macroeconomists or anything like that, but I think we brought up some interesting questions that haven't been asked. Right. Like the idea of like, how does it affect the average investor? You just don't see people talking about that. The idea of we're going into this thing and what's the opportunity and why is the rising interest in real estate really, really happening and where it's going. I think we uncovered some new ground there, and the idea of like thinking about this as a, in the near future, people investing in real estate will be like 401k investors that don't call themselves stock market investors.
Yeah, I like that.
Because people are going to be forced to continue to seek their own financial independence, not based on like the prior system, because things are changing.
Mm-hmm.
So I thought that was really good. And I want to thank the community for being here, having great questions. We had 50 plus people here today, middle of the workday. You're still here. Never take that for granted that you're here. So really appreciate you being here. And I'll give it up to you, GC.
This is awesome. I love kind of trying a little bit of a step outside of our comfort zone. I feel like you all have made it really easy for Pablo and I to just kind of show up and give our thoughts on things that are relevant to you and to the overall economy and the investing world. And we love that opportunity. And so I think today was a pretty cool milestone for us to talk about something we had never really talked before. And you know what? Just feels good, man. So thank you guys for creating the space for us to do what we love to do.
And the POT Dubs this Thursday, we got a guest investor on.
Oh, we do.
We got a guest investor.
We do.
So you're going to see a new story, new context of somebody using real estate themselves, see how their portfolio has grown. You can contextualize that to your own thing. So come ask questions from someone that's done it before. I think that's some of the more valuable stuff to anybody that's thinking about getting into the rental property game.
Mm-hmm.
Specifically, if you're thinking about doing it with JWB also,
mm-hmm.
right? Like the ability to ask somebody that's been doing it and is doing it, that isn't Greg, or, like I'm also an investor and I'm not technically an employee for JWB, but I know that, I'm also on the show all the time, right? Somebody that's completely separated from the platform that you get to ask questions for. Come on Thursday, ask whatever questions you got. I promise to moderate it. And in the meantime, if you don't want to deal with all this nonsense with the debt ceiling and posturing and all this crap, the one thing that you have to do is what you see.
Don't be average.
See ya.
See ya.